In this week's update, more rate pain for Australia, recession looming, businesses to be really squeezed, copper deficit coming to a store near you, and gold held back by higher rates. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with a perspective on what's going on, and we've been immune from a recession for 3 decades or more, but our economic luck may just be running out because a whole lot of factors are coming together now. And anyone that's watched this video for any length of time knows that I'm a real glass half full kind of person. You're always better off having a positive outlook, but the number of issues that are mounting up at the moment really is becoming quite significant. And it's pretty obvious now that from the middle class down are really under mounting pressure. And I get the feeling that the cycle really is only just getting started. Many businesses are under increasing margin pressure from cost increases and the inevitable consumer slowdown that is going to come. If you sat down to write a list of all the headwinds that are facing consumers, it's a considerably long and depressing list. So I don't think there's much doubt that we're going to see some sort of economic contraction, and then of course there'll be job losses that go with that, and so the spiral goes on. So it's not a pretty picture at the moment, and it pains me to say it, but you can paint a pretty grim picture for society where our political leadership, and this is not a political statement, it applies across the spectrum to all parties, our political leadership is failing in an absolutely dismal fashion. So it's hard to see what is going to turn around some of these very considerable headwinds and put us back on a better path. Now, our market, of course, it's not my role to be a social commentator, but to comment on the market and where we can best invest and how we can best invest. And the market will not be immune from all of the forces that I've just discussed above. And, a return to the early 90s in terms of the economic and social pain is quite real. I think it's going to be most unwise to simply go along with the old diversified formula. And look, that's really easy to do because we've all got busy lives, and if you're not someone that's really interested in investing, it's just something that you have to do, then it's just so easy just to slip into the old formula of buying the household names and diversifying your portfolio. But it's going to be very unwise to do that in coming years. So I think investors really must look for the niches that are going to continue to expand and profit and prosper. And that's pretty much all that I ever talk about in this Sunday video. It's finding those parts of the market where you can do well and just forget about the rest. So I think this message is never been any more important than it is at the moment. Let's turn to America. The S&P was up 0.4% across the week, and the US market is certainly moving ahead very nicely, and it's defying a lot of what I just talked about, which also applies to America. And I guess the difficulty here for investors is knowing the time span under which these things are going to come to fruition. We did see last week, I guess the notable story that I talked about last Sunday was the big move, the sudden move in the Russell 2000 for small caps. And that excellent momentum that occurred the Friday before last had excellent follow through during last week. And the Russell was the outperformer last week. US dollar index did edge down to 103.5. The yield didn't really change much, up about 0.02%. But the VIX is down to 13.8. I mean, we're getting down to levels that we saw in 2017, 2018 when the market complacency was really quite extreme. So 13.8 is a very low reading compared to what we've seen over the last 3 years. And the 10-year, 2-year spread continues to scream recession at negative 0.84. So let's jump into the charts. And I'll start with the Russell 2000. And this is where we stood a week ago. This was the huge move on Friday on nearly double the normal volume. And this is a massive ETF, 48 million shares at $180 a pop. It shows you the level of turnover for that. So for that sort of volume increase, it really was really something very significant. So that was where we stood a week ago. Let's see what happened as it unfolded. Bit of a rethink, bit of profit taking on Monday. That's pretty normal. Then another big surge on Tuesday on even larger volume. So that was incredibly positive. Followed up again with a gap opening on Wednesday. And again, the volumes being sustained here very significantly. Bit of a pause day, bit of an undecided day on Thursday, as you can see. And then we finished off the week, again, down slightly. But overall, for that 6-day period, enormously positive. So you've got to conclude that the momentum and the money flows in America are moving strongly in that direction. And this was also in a week when the moves by the US Treasury Department to raise more money must be sucking some capital out of the equities market. So this was terribly impressive. If we look at the Nasdaq, still continues to rise very strongly. This moving average here is the 8-day moving average, and it's sustaining itself above the 8-day moving average. That's how strong the trend is. I mean, normally a strong trend will track along to the 20-day, which is this one, but we're not even getting back to there. So this is enormous strength in the US market, which sort of defies the logic. No, it definitely defies the logic, that's for sure. But as I've said for many years, logic is overrated in the stock market, and you've got to pay more attention to the actual charts themselves. This is the equal weighted S&P 500 that I showed last week. Pretty much did what the S&P the market cap weighted one did. You can see some very nice volume spikes in that equal weighted index, but this is the S&P edged ahead. Really not a great deal happened there during the week. Let's look at where some of the individual money flows went. Nasdaq versus the S&P continues to rise very strongly. Semiconductors versus the S&P similarly. This is an absolute rocket ship, the S&P, which are the semiconductors. The relative comparison charts between the various sectors over the last quarter, no real change in that order. Although consumer discretionary, thanks to Tesla and Amazon, really have powered that along, and you'd have to say that over the last couple of weeks that consumer discretionary has probably been the outperformer in America. But I can tell you that's a heck of a lot about Tesla, which makes up about 20% of that particular index. So that sort of waters down its importance. And finally, this is the Russell 1000 growth versus 1000 value. So again, you can see the money flows are unequivocally clear in America. Now, if we just check out the currencies, there's the US dollar on a weekly chart. So a bit of indecision the week before, turned down a little bit. So we're really still stuck in this range between 100.5 and around 105. And I'll have another comment to make about the US dollar when we get to gold. And just the Australian dollar. So the Australian dollar rebounded very strongly, and commodity prices did reasonably well during the week as well, and that certainly helped. So it's been quite a strong rebound there. All right, Aussie Stocks, 66.72 is where we finished. Our index was down 0.3% across the week, and it's doing nothing. The sideways shuffle continues at the ASX 200 level. The leaders, technology, materials and healthcare are the leading sectors, and really just forget the rest. So let's just take a look at those sectors. So we'll start with materials. So what I want you to focus in on here is the red line, the 200-day moving average, just the orientation of that, the direction of it. Is it pointing up, sideways or down? And where the index is in relation to that 200-day moving average. And then, of course, also where the shorter-term moving averages are. So quite clearly, the materials sector is looking quite positive, and it's looking far better than the ASX 200, which is just flat and has been flat for 3 years. So if you're looking to try and make headway with a widely diversified portfolio, then, and you're wondering why you're not getting anywhere, then that's why, because it's just a sideways shuffle. This is the information technology sector, so it's done really well, really picked up following the US market, and you can see again all the moving averages all lined up in the way that they should be. Healthcare has done quite well, so the 200-day pointing up, and the price well above that. But when you look at finance, pretty disappointing. We've now got the 200-day moving average rolling over. So, if you've got a portfolio that's heavily weighted to the banks, and the outlook for the banks is not great in a contracting economy, then, don't expect too much for some time. This is energy. 200 days still pointing up, but that's really only off the strength of what we saw back here in 2022. The current situation is pretty flat for the energy sector. And looking at the emerging companies index, which is 200 companies in the bracket from 350 to 600 by market cap, and it's really looking pretty negative as well. But the good news is that there are niches. A lot of them are around materials, critical minerals, and also technology. There are stocks and sectors that are doing well. They're narrow parts of the market, but that's what you want. That's the part of the market that you want to be after. All right, turning now to precious metals. Gold was up $13 to 1961. Logic says that gold should be much higher, and I'll come back to that in just a minute on the next slide. But the money flows are just not supporting gold, and it's quite hard to understand why that's the case. But we've been in that situation now for quite a number of years. The Australian dollar gold price slipped a bit further, down to 29.39, but look, that's still profitable, very profitable territory for Australian gold miners. If you look at GDXJ, it's really just reflecting the weakness in the metals. But I thought I would just share with you some comments that I read from a gentleman called Jake Klein, who's the executive chairman of Evolution Mining, which is our second biggest miner now that Newcrest is disappearing from our market. And he makes a very strong and logical case for why gold should rise, and why gold should rise a great deal. And I think in the end, he will be proven correct, but the time frame under which that's happening is really very, very hard to discern. Essentially, he identified a number of reasons why gold should be rising and will rise a lot further in the future, bearing in mind this is his opinion. The global financial distress, and I don't think anyone can argue with that. Wherever you look, the escalation of debt and the stresses that's going to cause, increasingly, we've got a situation that's not getting any better, and it's getting significantly worse. If you focus in on the world's largest economy, the US, their debt is now 31 trillion plus a bit, and it's growing at $100 million an hour. Now, I don't know about you, I can't really get my head around $100 million an hour, but it doesn't sound like a very good position to be in. The demise of the US dollar as a reserve currency is very, very significant as far as gold's concerned, and certainly both China and Russia would be delighted to see diversification away from the US dollar. And so that would have enormous ramifications for the world's financial system, quite aside from the impact, the pricing impact on gold, but just the destabilisation that will occur as I think the world does progressively move away from the US dollar as a reserve currency. Now, again, this is a time frame that's extremely difficult to anticipate, probably not even worth thinking about, but the trend would appear to be there. And then, of course, we've got decarbonisation, which is going to add, pick a number, but $125 trillion was a number that was quoted to add to the existing inflationary forces. Gold should do well in an inflationary environment. So there's really no argument with that case for gold rising a lot, but then that case has existed for a number of years, and it's moved gold up from around the 1600s in the last couple of years, but it's really probably not performing as many gold bulls thought it should and would like to see. So that's the situation for gold. Let's just look at the gold chart. So that's gold on a weekly. So we had a steadying week the week before, and then a little bit up. But in the short term, it has lost momentum. So we got up here in early May. So about 6 weeks ago, we formed a new intraday high up at 2,094. But since then, as we'll see from the daily chart, it's eased right back again. So it had a little look over the top, took fright, and is hurried back down into the 1900s, and really just going sideways at this point in time. So that's gold. Other commodities, copper was higher a little bit, 379. Nickel also up just a touch. What I find absolutely staggering and inconsistent with this, community, society-wide push for critical metals is that copper capex, so the capital expenditure on developing more copper mines, is 15% below the peak of the last cycle, which was in 2013. Now that's according to UBS. That's quite extraordinary when you think 10 years on and everything that's happened in the critical minerals space, that the amount of money being spent on copper is 15% less than it was a decade ago at the cycle peak. And so it really, when you combine that with the declining mine output, which is just a natural phenomenon that's always going to happen, and we've also got mining output decreasing for other reasons as well that also include weather, civil unrest, and nationalisation issues, then you put all that together and, just how does that marry up with sharply rising demand? So you've got inadequate investment, you've got output declining, you've got sharply rising demand, you've got to end up in a deficit, and yet the copper price is not looking forward 18 months to 2 years when this very significant deficit is going to hit. It's just looking at 5 minutes down the road. So as I've been saying now for several weeks, I think there's an enormous contrarian opportunity in the copper space. Crude oil, 70.34, down a little bit on the week, down $4 across the week. Just checking in on lithium, and also too the news around uranium is just continues to get better and better. But uranium is another one with gold that's been frustratingly slow live up to what the fundamental logic would dictate. But the lithium news continues to advance. The EU, in the EU, there were new EV sales in April, which were 52% up on the month before. That's according to the European Automobile Manufacturers Association. So that's very significant. How things have changed. Just go back a month or two where it was all doom and gloom for lithium, and now I'm reading that reportedly some lithium producers are holding back supply because they're waiting for prices. They're so confident that prices are rebounding that they're holding back supply. So the wheel has turned very, very quickly in lithium, which was always probable because the decline in lithium was A, manufactured to a degree, and B, just ran away from itself on sentiment. So this switch back to reality is no surprise. There's the spot copper chart, up a little bit, similar with nickel. So wrapping it up, the local economy is in for very tough times. I think if you don't factor that into your investment plans, then you're just not being realistic. And our ability to dodge recessions after 12 rate rises in 12 months has eventually got to take its toll. And there's no indication yet on what the RBA is saying that they're finished yet. There could be at least another one, and possibly another two, depending on what inflation does. And with the wages outcome just last week or the week before, that's got to add to inflationary pressures. So the chance of getting a spiral in wages feeding into higher prices, feeding into higher wages, and so it goes, becomes more likely. We're in a very precarious situation in Australia. And if investors want to prosper, then it's really essential to question the investment process that you're using. If you're doing the same old that you did last decade and the decade before that, then, I really don't like the outlook. There are only certain narrow parts of the market that are going to perform well. And so you just need to get real about the fact that you've really got to pay great attention to what you're doing in the investment market. Now, portfolio analyst last week, it was the Taking Stock session, which is a skills building session we do once a month. They're always very productive. We always get really good feedback from the perspective and the added skills that brings. That's it for this week. I'll be back with you next Sunday, hopefully with some more positives. And there's more information on the website. My email address is there, and I'll see you next Sunday. Cheers.